Insurance is this massive global industry, and it's all built on a very simple promise. If something bad happens, don't worry, we'll pay for it. But how can a company promise to pay for something that hasn't even happened yet? Well, the answer is a kind of financial fortune-telling, a billion-dollar guess.
And that really is the fundamental question at the heart of the entire industry. This isn't just a theoretical thing either. I mean, if you get this wrong, we're talking about financial collapse. So the answer has to be a massive, really carefully calculated guess. So insurers hold these absolutely massive sums of money in what they call reserves, just to cover future claims. But, and this is the crazy part, this huge number isn't a known cost. It's a super sophisticated prediction, an estimate of what's to come, based on all the clues from the past. Okay, so that's the core challenge, right? When your entire business relies on a multi-billion-dollar prediction, you have to be constantly asking yourself, is this number reasonable? Is our crystal ball even working correctly? All right, this is where the actuary steps in. Think of them as a financial detective. Their whole job is to investigate the evidence, double-check all the assumptions, and figure out if these colossal reserve numbers are actually justifiable. So, our financial detective, they've got two main lines of inquiry. First up, they run a bunch of diagnostic tests. You can think of it like taking the company's financial vital signs. And second, they look at what's actually happening out in the real world and compare it to what their predictions said should be happening. So let's dive into that first approach, the diagnostic toolkit. We're going to crack it open and see just how an actuary takes the financial pulse of their company. So what is a diagnostic in this world? Well, it's basically a high-level, does this make sense check. It's a key number or a ratio that helps an actuary see if their assumptions are holding up, or if maybe, just maybe, something's going wrong under the surface. It's amazing, but a single number, something like the ultimate loss ratio, can tell a whole story. So if that ratio starts creeping up, it might be a clue that claims are getting more expensive, or maybe the company is insuring riskier stuff. If it's going down, well, that could mean things are getting better, or it could just mean they're charging higher premiums. For our detective, this is the first breadcrumb telling them where to look next. But, the tools and the numbers, that's only part of the story. Because one of the biggest hurdles isn't in a spreadsheet. It's right inside our own heads. We have to talk about this psychological trap of just relying on last year's numbers. This is a really common cognitive bias. It's called anchoring. It's that thing we all do where we get stuck on the very first piece of information we see. Once that anchor's dropped, our brain just kind of adjusts from there, even if the anchor itself was totally random or wrong to begin with. And this puppy analogy, it's perfect. You loved your last dog, a golden retriever, so you automatically anchor on getting another one. But maybe your lifestyle has totally changed. You're in a tiny apartment now, or you work longer hours. You see? By anchoring to what you did in the past, you might make a totally wrong decision for your future. Now, for an actuary, this isn't just about puppies. The risk of anchoring is huge. They might anchor to last year's assumptions about, say, inflation or how people file claims. But if the world has changed since then, their models won't keep up. And that billion-dollar guess, suddenly it can become dangerously, wildly wrong. So it's not just about what's going on in your own head. Actuaries also have to wrestle with these huge external forces. The entire insurance market is basically a moving target, and it operates in these predictable but still really disruptive cycles. Yeah, this is what we call the underwriting cycle. Okay, so it kicks off with a hard market. Premiums are high, business is good. That, of course, attracts a bunch of new companies. All that competition drives prices down, and we end up in a soft market. But then, business isn't so profitable anymore, so companies start to leave. With less competition, prices can go back up, and we're right back in a hard market again. And here's the thing, this cycle doesn't just mess with prices, it completely messes with the data itself. In a hard market, maybe customers take on more risk themselves to save money. In a soft market, looser rules might lead to totally different kinds of claims. For an actuary, trying to make a prediction in this environment, well, it's like trying to hit a target that's constantly moving and changing its shape. Okay, so let's recap. You've got your diagnostic tools, you're trying to avoid your own biases, you're watching the market cycles, you're doing everything right. But what happens when two different experts look at the exact same data and come up with two totally different answers? Believe it or not, there are a ton of legitimate reasons why this happens. Maybe they use different benchmarks or different mathematical models, Or one of them got some crucial insight from chatting with the folks in the claims department that the other one didn't. Or sometimes it really just comes down to a genuine, experience-based difference of professional opinion about what's going to happen next.
And that right there, that gets to the real heart of the matter. Making this billion-dollar guess isn't just about plugging numbers into a formula. What this all shows us is that it's as much an art as it is a science. That professional judgment, the kind you only get from years of experience, is every single bit as critical as the math itself.
And as we get more and more data and our computer models get more and more powerful, this tension just keeps growing. The actuary's job is to somehow navigate this incredibly complex world of numbers and biases and wild market forces. So it really leaves us with this final big question. In an age of algorithms and big data, how do we find the right balance between the numbers and the necessary human judgment to make sense of it all?